Hi Charan, good morning. Are you able to listen my voice clearly? Okay. Shall we start? Today we will complete capital gains revision. So yes, we will start. Today's topic is capital gains. Very important chapter from examination point of. You can expect one question from capital gains, which is for 7 marks. And in case study, in MCQs, case study based MCQs also a question can be interlinked with capital gains concept. So minimum you can expect 7 marks from. You cannot skip. This chapter will also continue in your CA final. So this is the chapter which is something how to learn. Okay. We will start. See what are the sections covered under the head capital gains. Section 45 to 55. These are the sections that are covered. What is the charging section? Charging section is section 45. Actually, charging section is section 45(1). Okay. What is the method of accounting followed under the head capital gains? Method of accounting followed is accrual basis. That means generally capital gains head gets attracted whenever you sell any capital asset. So the year in which you are selling the asset or the year in which you are transferring the asset, in that year you are required to calculate. Are you able to understand? See, for example, in 24-25, I sold my house, but buyer paid me consideration in 25-26. When I got money in 25-26, but capital gains are not applicable in 25-26. Capital gains are applicable in 24-25. So the year in which capital asset is transferred on accrual basis, capital gains are applicable. Are you able to understand? Method of accounting followed is accrual tax rate. Tax rates applicable are normal tax rates as well as special tax rates. You know, right? In capital gains, special tax rates are applicable. Long term capital gain 112, 112A, short term capital gain section 1A. For these sections, special tax rates are applicable, and there is also amendment in Finance Act number 2 of 2020. So before 23rd July, one tax rate is there. After 23rd July, another tax rate is there. Tax rates are changed. So with regard to that amendment, question is asked in May 2025 examination. I am super expecting question will also be asked in September 2025 examination. Lecture duration, it will be till 12 p.m. or 12 or 12:50, 2 hours. So accrual basis except section 45 1A, 45 to 45.5 that we will discuss little later. 45 1A means, you know, uh, loss or damage or destruction of capital asset. 45 2 is conversion of capital asset into stock in trade. 45.5 is compulsory acquisition of capital. In all those cases, accrual basis is applicable. The year in which you get money, that year capital gains are taxable. Next. See, there is charging section, section 45.1. Charging section 45.1 prescribes two conditions. Condition 1, asset must be a capital asset. Condition 2, transaction must be a transfer. The conjunction is and. Only if these two conditions are satisfied, then only capital gains will get attracted. Otherwise, capital gains will not get attracted. Let's say I am having watch with me. I sold watch. If watch is capital asset, then capital gains tax is applicable. If watch is not a capital asset, watch is a personal effect. On sale of watch, I am not required to calculate capital gain. So charging section clearly says two conditions. Asset should be a capital asset, and whatever the transaction is there, transaction should be a transfer. Only if these two conditions are satisfied, then only capital gains are required to be calculated. Otherwise, capital gains are not required to be calculated. So like most of our discussion will be with regard to capital asset. Asset must be a capital asset, transaction must be a transfer. What do you mean by capital asset? Capital asset definition have some inclusions as well as some exclusions. What is important is exclusions to definition of capital asset. See, capital asset includes all assets, whether asset is movable asset or immovable asset, tangible asset or intangible asset, whether asset is used for business or whether asset is used for personal purpose. Very simple. Every asset is capital asset except those assets which are excluded from definition of capital asset. Are you able to understand? So every asset we will treat as capital asset other than those which are excluded from definition of capital asset. So very clear, every asset is a capital asset. What are exclusions? Exclusions to definition of capital asset. Stock in trade is excluded from definition of capital asset. Why? Stock in trade is already taxable under PGBP. If stock in trade is not excluded, then stock in trade will also get taxed under capital gains. So stock in trade will get taxed under PGBP. It will also get taxed under capital gains. It will lead to double taxation. To avoid double taxation, whatever stock in trade is there, it is excluded from definition of capital asset. So on sale of stock in trade, only PGBP head gets attracted, capital gains head will not get attracted, and it is taxed only once. Are you able to understand? Personal effects. Sir, what do you mean by personal effects? To call any asset as personal effect, three conditions are required to be satisfied. Condition 1, it must be a movable asset other than security. Movable asset other than security. Second, it should be used for personal purpose. Personal purpose by SSC or his family members. Third condition, excludes, personal effect excludes jewelry, drawing, painting, sculpture, archaeological collection, any other work of art. These three are excluded from definition of personal effect. So let's say I am having my own building. So building is owned by me. So I am the owner of the building. Even though I am using building for my residential purpose, still I cannot call building as personal effect, because to call any asset as personal effect, it should be a movable property. So immovable property, even though used for personal purpose, it is not personal effect, it is a capital asset. Similarly, I purchased Reliance company shares. Whenever I purchase Reliance company shares, shares are movable asset only. Okay, so but after like personal effect definition, what it says, personal effect means any movable asset other than securities. So whatever shares and securities are there, even though you purchased them for personal purpose, they are not personal effect, they will be treated as capital assets. Are you able to understand? So to call an asset as personal effect, first it should be a movable asset, it should not be a security. Second, it should be used for personal purposes of SSC or his family members. Third, whatever the movable asset is there, okay, That movable asset should not be a jewelry, should not be a drawing, should not be a painting, should not be a sculpture, archaeological collection, work of art. That means what? All these things, even though purchased for personal purpose, still they are not personal effect. They will be treated as capital asset. Are you able to understand? So what personal effect means? Three conditions. To call any asset as personal effect, first of all, it should be a movable asset, it should not be a security. That means immovable asset is always personal effect. I sold my land, which I am using for my personal purpose. Still, it is a capital asset. On sale of land, I am required to calculate capital gains. I sold shares and securities. Even though they are movable asset, they are not personal effect. You are required to calculate capital gains. Let's say I sold my shoes. Shoes are like use movable asset. Shoes are used for personal purpose. Shoes are not a jewelry, drawing, painting, sculpture, archaeological collection. So whenever I sell shoe, if I make any profit on that profit, I am not required to pay any tax. Are you able to understand? Because shoe is a personal effect. So to call asset, if asset is personal effect, then capital gains will not arise. If asset is not a personal effect, then it will be treated as capital asset. Once it is treated as capital asset, capital gains will arise. So to call any asset as personal effect, first of all, that asset should be a movable asset. It should not be a security. It should not be a immovable asset. Next, that movable asset should be used for personal purposes of SSC, and movable asset should not be jewelry, drawing, painting, sculpture, archaeological collection, work of art. Are you able to understand? So that we call as personal effect. Any asset, if it is personal effect, then no capital gains will arise. On transfer of personal effect, no capital gains will arise. If asset is not a personal effect, then it will be treated as capital asset. On transfer of such capital asset, capital gains will arise. Are you able to understand? Next, rural agricultural land is also excluded from definition of capitalism. So, like on sale of agricultural land, you have to determine whether this agricultural land is urban agricultural land or rural agricultural land. If agricultural land sold is urban agricultural land, then it is capital asset, capital gains will arise. Okay. If like if rural agricultural land is sold, then it is not a capital asset, capital gains will not. So very simple thing, whatever the agricultural land that you are selling, on sale of such agricultural land, generally capital gains are required to be paid. Okay, tax is required to be paid on capital gains. But you need to check whatever the agricultural land that you have sold, whether it is urban agricultural land or rural agricultural land. Whatever the agricultural land that you are selling, if it is urban agricultural land, it is a capital asset. On sale of such agricultural land, you are required to calculate capital gains and you are required to pay tax on capital gains. Second case, whatever the agricultural land that you are selling, if it is rural agricultural land, on sale of rural agricultural land, you are not required to calculate capital gains because rural agriculture is a capital asset. Are you able to understand? Now, sir, how to tell whether agricultural land is urban agricultural land or rural agricultural land? So, criteria is there. If population in a place, if population in town, village or city, if it is less than or equal to 10,000, in that area, in that village, if you have any agricultural land, then it is considered as rural agricultural land only. Are you able to understand? If population in place is more than 10,000 and up to 1 lakh, then whatever that area, municipal area is there, along with that municipal area, 2 kilometers from local limits of municipality will be treated as uh, you know urban area. Outside that, if there is any agricultural land, that we call as rural agricultural land. I will tell one example. Let's say here population is more than 10,000 up to 1 lakh. Now 2 kilometers, 2 kilometers. That means what? Whatever the population is there, see, this is specified area. If agricultural land is there within specified area, then we call it as urban agricultural land. If agricultural land is there outside specified area, then we call it as rural agricultural land. Are you able to understand? So very simple. If population in a place is less than 10,000, in that village, whatever the agricultural land that you are having, it is rural agricultural land. If population in a place is more than 10,000 and up to 1 lakh, in that case, whatever that municipality is there, that municipality is urban area. Along with that municipality, 2 kilometers from the end of the municipality is also treated as urban area. Within that urban area, if you have agricultural land, that is urban agricultural land. Outside that, that means after 2 kilometers from end of municipality, if you have any agricultural land, that agricultural land we call as rural agricultural land. Are you able to understand? Next, case 2. Now I am changing little bit of details. If population in a place is more than 1 lakh up to 10 lakh, then this is specified area. Along with this, whatever 6 kilometers from the end of the municipality is there, 6 kilometers from the end of the municipality, even this area is also considered as specified area or urban area. Are you able to understand? Vijayawada is there. In Vijayawada, population is, let's say, 8 lakh population. Actually, it is more than 10 lakhs only, but let us assume in Vijayawada population is 8 lakhs. Now entire Vijayawada is urban area. Along with Vijayawada jurisdiction, from end of Vijayawada jurisdiction, see, municipality will end at certain point, right? So from end of municipality, next 6 kilometers aerial distance, whatever the area is there, that area is also considered as urban area. So within urban area, if you have agricultural land, it is urban agricultural land. Outside urban area, if you have agricultural land, it is considered as rural agricultural land. Are you able to understand? Now, case 3. What case 3 says? Like if population is more than 10 lakhs, 8 kilometers from the end of the municipality, that will be treated as urban area. What do you mean by this? Hyderabad is there. Hyderabad population is 1 crore. That means Hyderabad population is more than 10 lakhs. So entire Hyderabad is urban area. From ending of Hyderabad, next 8 kilometers, whatever the municipality is, like whatever the 8 kilometers from end of municipality is there, even that is also considered as urban area. Within urban area, if you have agricultural land, that is urban agricultural land. Outside 8 kilometers, if you have any agricultural land, that will be considered as rural agricultural land. Are you able to understand? So very simple. Agricultural land located in urban area, urban agricultural land, it is a capital asset, you need to calculate capital gain. Agricultural land located outside urban area, outside urban area means rural area. So in rural area, if you have agricultural land, it is rural agricultural land. On sale of rural agricultural land, you are not required to calculate gains. Able to understand? So population in place less than or equal to 10,000, it is rural area. Population in a place more than 10,000 up to 1 lakh, that area is municipal area, urban area. Along with that area, 2 kilometers from the end of the municipality is also considered as urban area. Population in a place more than 1 lakh up to 10 lakh, that area is urban area. Along with that area, next 6 kilometers from end of municipality, it is also considered as urban area. Population in a place more than 10 lakhs, that area is urban area. Along with that, next 8 kilometers is also considered as urban area. Within urban area, if you have agricultural land, it is urban agricultural land. Outside, it is rural agriculture. Is it clear? Next, 6.5 gold bonds issued in 1977, 7% gold bonds issued in 1980, national defense bonds. See, these are all issued in 1977, 1980. These are not in existence. So from this, no question will come. This type of securities are not there in existence right now. Actually, these are to be removed from definition of cap, like capital asset, but as our act is very old, it was not removed. I hope in upcoming income tax act 2026, they are going to remove these points. Next, deposit certificates issued under gold monetization scheme. See, whenever you subscribe to gold monetization scheme, what you will do, you will deposit your gold. After depositing your gold, you will get deposit certificate. See, just like when we deposit our money in fixed deposit, he will give fixed deposit certificate. Now, in the same way, when we deposit gold in gold monetization scheme, he will give that certificate, gold monetization certificate. So, whatever the deposit certificate issued under gold monetization scheme, there, if I sell this deposit certificate, I am not required to calculate capital gains because deposit certificate is not a capital asset. Are you able to understand? Next, we will see the definition of transfer. So, did you understand the definition of capital asset? Comment. Sir, in capital asset definition, please ask. You did not. So, shall I proceed further with the definition of transfer? Everybody. Yeah, any securities held by foreign institutional investors. One small thing, my main business is buying and selling of shares. For me, whether shares are capital asset, no, shares are considered as stock in trade. Correct. But in case of foreign institutional investor, even though his main business is buying and selling of shares, but if he purchases shares of Indian company, let's say Tesla Limited is there, it is also into stock market. Now, what Tesla Limited is doing, it is purchasing shares of Indian companies, it is selling shares of Indian companies, it is making money. Okay, now Tesla Limited, it is foreign institutional investor, it is buying and selling shares of Indian company. Its main business is buying and selling of shares. So, Indian company shares are, as per accounts, they will be treated as stock in trade. But as per income tax, even though their main business is buying and selling of shares, still whatever the Indian company shares and securities that are purchased by foreign institutional investor are there, they are not treated as shares, they will be treated as capitalists. Are you able to understand? So foreign institutional investor, if he buys shares and securities of Indian companies as part of their business, even though it's their regular trading, still they are not treated as stock in trade, they will be treated as capitalists. Okay. Next, we will discuss definition of transfer. Only if transaction is covered under the definition of transfer, then only capital gains will be calculated. Otherwise, capital gains will not be calculated. What do you mean by this? Let's say I gifted gold bracelet to my brother. On gift of gold bracelet, okay, gift transaction is excluded from definition of transfer. So in case of gift, I am not required to calculate capital gains. So if any transaction is covered under the definition of transfer, then only you are required to calculate capital gains, then only you are required to pay tax on capital gains. So if any transaction is not covered under the definition of transfer, then you will not calculate capital gains. Capital gain tax is not required to be paid. Are you able to understand? Now we will see transfer definition have some inclusions, transfer definition also have some exclusions. So if any transaction is included in definition of transfer, we will calculate capital gains. Otherwise, we do not calculate. Are you able to understand? Transfer includes, that transaction transfer includes sale. That means if you sell any capital asset, you are required to calculate capital gains. Not only selling, if you exchange your capital asset, even on exchange of capital asset, you are required to calculate capital gains. Let's say I transferred my building to Charan. Building transferred 60 lakhs worth of shares to me. That means I am exchanging my building with shares of Charan. Even this exchange transaction is also considered as transfer, and capital gains are required to be calculated. So exchange of capital asset. On exchange of capital asset, we are required to calculate capital gains. Next, relinquishment of rights in a capital asset. I took one building on lease for 10 years. Every year lease is every month lease is 50,000 rupees, and this 50,000 rupees will increase by 10% year on year. So next year lease rent is 50,000 plus 10%, 55,000. Second year lease rent is 55,000 plus 10%. In that way, lease rent will increase by 10% year on year. Are you able to understand? Now, I took one property on lease. Lease rent is 50,000 rupees. Immediately, Jagadish came to me. Jagadish came to me and told, "Sir, I want that premises. I will pay rent of 50,000 rupees. You took it on lease for 10 years. Now, I will pay 6 lakh rupees to you. Transfer those lease rights to me." So, what I have done, like I am lessee, I transferred lessee rights to Jagadish. So, from tomorrow onwards, Jagadish is the lessee. Every month he will pay rent of 50,000 rupees. I will never, I will enjoy the benefit. I will take 6 lakhs. I will come out of the lease. So here what is happening? Whatever the lease rights that I am holding, that lease rights I am losing to Jagadish. So relinquishment means what? Giving up of right. So if I give up my lease rights to Jagadish and if I make profit of 6 lakh rupees, then in that case also I am required to calculate capital gains, because even relinquishment of capital asset is also treated as transfer. Relinquishment of right in capital asset is also treated as transfer. Next, extinguishment of capital asset. Extinguishment means what? Complete cancellation of capital asset. So destruction of capital asset. For example, like debentures were redeemed. There is redemption of debentures. I purchased debentures. 5 years duration is there. After 5 years, company redeemed the debentures. What do you mean by redemption? Like I gave back my debenture certificate, company gave me money. So once I give back my debenture certificate, that debenture certificate will be torn off. It will be cancelled. Even cancellation of capital asset, even destruction of capital asset, even extinguishment of capital asset is also considered as transfer. That's why extinguishment of capital asset. So if building gets collapsed, if we get insurance compensation, then also we are required to calculate capital gains, because even destruction of capital asset is also considered as transfer. Are you able to understand? So even extinguishment. Sir, what is difference between extinguishment and relinquishment? In case of relinquishment, asset will continue to exist. However, in case of extinguishment, asset will not continue to exist. Asset will be collapsed, or asset will be destructed, or asset will be cancelled. That is the difference between relinquishment and extinguishment. Even both relinquishment and extinguishment are treated as transfer, and capital gains are required to be calculated. Compulsory acquisition of capital asset by government. Whenever government do compulsory acquisition, that is also treated as transfer. We are required to calculate capital gains. Conversion of capital asset into stock in trade. What do you mean by this? Let's say I am having with me 50 kgs of gold. Please don't believe it as true. Okay, don't call income tax department. 50 kgs of gold is not there with me. Okay, it is just an example. Okay, so 50 kgs of gold is there with me. I thought I can start gold shop. I started gold shop. So whenever 50 kgs of gold is there in my house, it is like it is capital asset. But whenever that gold is moved into gold shop, it will be treated as stock in trade. Even conversion of capital asset into stock in trade is treated as transfer, and capital gains are required to be calculated. Are you able to understand? Redemption of zero coupon bonds. You know zero coupon bonds, right? They are always issued at a discount and are redeemed at par, redeemed at face value. So even redemption of zero coupon bonds is treated as transfer, and capital gains are required to be calculated. Transfer by way of part performance of contract. Section 53A of Transfer of Property Act. Yesterday in house property lecture, I have discussed with you deemed ownership concept. In that case, I told this case as well. Like there should be agreement between seller and buyer. Buyer has paid the consideration or buyer is ready to pay the consideration. Buyer has taken the possession of the property. Buyer has taken the control of the property. If these three conditions are satisfied, even though on registration documents seller is the owner, still buyer will be considered as deemed owner of the house property. Do you remember that provision? So same, that provision deemed ownership concept is from buyer point of view. Under capital gains we will think from seller point of view. So what seller point of view, if there is agreement between seller and buyer, if buyer has paid the consideration or buyer is ready to pay the consideration, and if buyer has taken the possession of the property, if all these three conditions are satisfied, even though on registration documents seller is the owner, still it will be deemed as seller has sold the house property or seller has sold the capital asset and seller is required to calculate capital gains. That means what? You need not wait till actual registration. The moment these three conditions are satisfied, it will be deemed as transferred and capital gains are required to be calculated. Are you able to understand? So these are all inclusions to definition of transfer. Now, shall I explain exclusions to definition of transfer? Everybody, exclusions to definition of transfer. So I hope students are following. Please give comments as much as possible. So I feel it as lively. I can feel that I'm speaking with you. Next, exclusions to definition of transfer. If any transaction is excluded from definition of transfer, on such exclusion, you are returns. I got a building from my father. Transfer of building from father to son upon death of the father. Even there is transfer of property from one person to another person. Transfer of property from father to son. Even though there is transfer of property, it is by way of inheritance. So by way of inheritance, if any property is transferred, capital gains are not required to be calculated. Why? Because inheritance is excluded from of transfer. So gift transaction, will transaction, inheritance transaction. By these three ways, if you transfer any capital asset, capital gains are not required to be calculated because these three transactions are excluded from definition of transfer. Is it clear? Transfer of capital asset on total or partial partition of HUF. See, Hindu undivided family will get divided, right? Ambani family is there. In Ambani family, there are three children, Akash, Anant and Isha. So at some point of time, Ambani family will get separated. Whenever Hindu undivided family gets divided into small families, there will be transfer of capital assets from Hindu undivided family to small family. Such a transfer of capital assets is not treated as transfer and no capital gains are required to be calculated. Are you able to understand? Uh, Transfer of capital assets from holding company to subsidiary company. Let's say Reliance Limited is there, Geo Limited is there. Both are Indian companies. Reliance is Indian company, Jio is also Indian company, and Reliance Limited is having 100% shareholding in Jio Limited. Now, whatever the capital assets transferred from holding company to subsidiary company are there, or whatever the capital assets transferred from subsidiary company to holding company is there, this transfer of capital asset is not a transfer and no capital gains are required to be calculated. Are you able to understand? No capital. So very simple, transfer of capital asset from holding company to subsidiary company or subsidiary company to holding company. Not treated as transfer. No capital gains are required to be calculated subject to satisfaction of two conditions. What are those two conditions? Condition number one, holding company shall have 100% stake in subsidiary company. That means whatever subsidiary company is there, it is wholly owned subsidiary company. That is condition 1. Condition 2 is Condition 2 is recipient company should be an Indian company. Recipient company should be an. If these two conditions are satisfied, transfer of capital assets from holding to subsidiary or subsidiary to holding, the transfer of capital assets is not treated as transfer and no capital gains are required to be calculated. Is it clear? Subject to satisfaction of two conditions. Holding company shall hold 100% stake in subsidiary company, and subsidiary company must be, like recipient company must be an Indian company. If these two conditions are satisfied, transfer of assets from holding to subsidiary or subsidiary to holding is not treated as transfer. Yeah. Vodafone Idea merged together. They formed a new company, VI. Now, there will be, at the time of amalgamation, there will be transfer of capital assets from amalgamating company to amalgamated company. This transfer of capital assets is not a transfer and no capital gains are required to be calculated, subject to the condition amalgamated company must be an Indian company. Is it clear? So you all know amalgamation. When during the course of amalgamation, capital assets will be transferred from amalgamating company to amalgamated company. That is not treated as transfer, subject to the condition amalgamated company must be an Indian company. Is it clear? Now, shareholders of amalgamating company will get shares of amalgamated company. Am I correct? Let's say I am shareholder of Vodafone Limited. At the time of amalgamation, what will I do? I will submit Vodafone shares and I will take VI shares. So there is exchange of two capital assets. Am I correct or not? I am exchanging my Vodafone share with VI share. Even this exchange of Vodafone share with VI share is not a transfer and no capital gains are required to be calculated. So exchange of amalgamating company shares to get amalgamated company shares, that is also not treated as transfer and no capital gains are required to be calculated. Is it clear? Demerger. See, let's say there are Tata Limited is there. Tata Limited got demerged into Tata Limited and Tanishq Limited. Now, at the time of demerger, there is transfer of capital assets from demerged company to resulting company. Here, demerged company is Tata Limited, resulting company is Tanishq Limited. So, at the time of demerger, what is happening? Capital assets are transferred from demerged company to resulting company. This transfer of capital assets is not a transfer and no capital gains are required to be calculated. Are you able to understand? And subject to the condition, resulting company must be an Indian company. Then only this provision is applicable. It will not be treated as transfer. Very simple. During demerger, transfer of capital assets from demerged company to resulting company, not a transfer. No capital gains are required to be calculated. Subject to the condition, resulting company must be an Indian company. Is it clear? Now, let's say Tata Limited is transferring 400 crores of assets from Tata Limited to Tanishq Limited. Now, what Tanishq Limited will do? It will allot shares to shareholders of Tata Limited. Now, what Tata Limited shareholders? Tata Limited shareholders are losing 400 crore worth of value in their shares and they are sacrificing 400 crore worth of shares for Tanishq Limited. Now, Tanishq Limited is allocating new shares to the shareholders of Tata Limited in Tanishq Limited. Now, what's happening? Like, I am shareholder of Tata Limited. I am losing 400 crore worth of value in my shares and I am transferring those assets to Tanishq Limited. So I will get shares in Tanishq Limited. So this is a relinquishment. I am giving away 400 crore worth of assets. For that, I am getting shares in Tanishq Limited. So allocation of shares in resulting company to the shareholders of demerged company is also not treated as transfer and no capital gains are required to be calculated. Is it clear? Transfer of government security, rupee denominated bond outside India by a non-resident to another non-resident. See, there are two non-residents, Steve Smith and Ricky Ponting. Both are non-residents, na? So what they have done, they have, like, Steve Smith transferred capital asset. Steve Smith transferred capital asset to Ricky Ponting. Now, what is that capital asset? That capital asset is rupee denominated bond or government security. Where they are transferring outside India, they are transferring this capital asset in Australia. So if there is a transfer of either rupee denominated bond or government security outside India, okay, then in between, whose the transaction is happening in between one non-resident and another non-resident. Where the transaction is happening, the transaction is happening outside India. So even though capital asset is transferred, this is not a transfer and no capital gains are required to be calculated. Are you able to understand? So three conditions: transaction should take place in between one non-resident to another non-resident, capital asset required to be transferred is rupee denominated bond or government security. Condition 3, that the transaction should happen outside India. If all these three conditions are satisfied, then the transfer of rupee denominated bond or government security is not a transfer and no capital gains are required to be calculated. Is it clear? Redemption of sovereign gold bonds by an individual. See, like RBI will issue sovereign gold bonds. I will purchase sovereign gold bonds. At one point of time, government, like RBI, will do redemption of sovereign gold bonds. At the time of redemption of sovereign gold bonds, if I get any money, on that money I am not required to calculate capital gains. Is it clear? Conversion of gold into electronic gold or vice versa. See, there are certain cases: conversion of preference shares into equity shares, conversion of debentures, bonds, deposit certificates into shares or securities. Next, conversion of gold into electronic gold or conversion of electronic gold into physical gold. All these transactions are not a transfer. No capital gains are required to be calculated. Are you able to understand? I will tell one example. I am having preference shares. I am submitting preference shares and I am taking equity shares. So there is conversion of preference shares into equity shares. I surrendered preference shares and I took equity shares. Even this conversion of preference shares into equity shares is not a transfer and no capital gains are required to be calculated. There is exchange of two capital assets. I exchanged preference share with equity share. Generally, if there is exchange, it is a transfer, but exception is exchange of preference share with equity share, not a transfer. No capital gains are required to be calculated. Is it clear? Next, see, jewelry, drawing, archaeological collection, painting, work of art. Generally, if you sell these, we have discussed in exclusion to definition of personal effect. Whenever we sell this, we are required to calculate capital gains. But if you sell these assets, jewelry, drawing, painting, sculpture, archaeological collection, work of art, if you sell this to government or government notified institutions or government notified universities, in that case, you are not required to calculate capital gains because the transaction is excluded from definition of transfer. Okay. Next, transfer of capital asset under reverse mortgage. You know reverse mortgage, right? Let's say old couple are there who are resident in India. They do not have any money. They cannot do employment now. They are already above 70 years of age. Now what can they do? If they have any house property, they will mortgage this house property. Bank will give monthly income or bank will give lump sum income. With that amount, they can pay for their medical expense. Now, whenever house property is mortgaged with bank, capital gains are required to be calculated. But in case of reverse mortgage, the transaction is excluded from definition and capital gains are not required to be calculated. Is it clear? Are you able to understand? So this is the completion of definition of transfer. So till here, are you clear? Do you have any doubt? Please ask me. Yes. Shall I explain further? Next, nature of capital asset. Please listen carefully because there is amendment in this provision in Finance Act number 2 of 24. See, generally, when I taught you capital gains in classroom, I told there are three classifications. Okay. So on which basis we will tell whether capital asset is long-term capital asset or short-term capital asset? Three criteria is there. Category 1, category 2, category 3. So based on these three criteria, we are going to determine whether it is long-term capital asset or short-term capital asset. But on or after 23rd July 2024, there are only two categories, category 1 and category 2. Okay. So whenever capital gains question come, high chances you will commit mistake. Why will you commit mistake? The reason that you will commit mistake is you do not check the date. First, you have to check the date whether transfer happened before 23rd July or after 23rd July. If transfer happened before 23rd July, three criteria are there. If transfer happened on or after 23rd July, only two criteria are there. Are you able to understand? I hope I am teaching moderately, not too fast or not too slow, because this is revision class. I cannot explain slowly provision by provision. That will only happen in regular class. So we have less time to do revision. I hope it is moderate. Are you able to follow the speed at which I am going? Okay, good. So before 23rd July, before 23rd July 2024, to tell a capital asset as long-term capital asset or short-term capital asset, how many categories are there? Three categories are there. Now you will get another doubt. Sir, why we need to tell whether it is long-term capital asset or short-term capital asset? Because if it is long-term capital asset, we will calculate long-term capital gain or long-term capital loss. If it is short-term capital asset, we will calculate short-term capital gain or short-term capital loss. Sir, what is the difference? For long-term capital gain, tax rates are different. For short-term capital gain, tax rates are different. So it is very crucial to determine whether a capital asset is long-term capital asset or short-term capital asset. Are you able to understand? Now, before 23rd July, okay, listed shares other than securities. Next, zero coupon bonds, units of UTI, units of equity oriented mutual fund. You can see here listed shares, listed securities other than units. I am sorry, not other than securities, other than units. Listed shares, listed securities other than units, zero coupon bonds, units of UTI, units of equity oriented mutual fund. If these capital assets are transferred, then criteria is 12 months. If they are held for more than 12 months, they are classified as long-term capital assets. If they are held for either 12 months or less than 12 months, they are classified as short-term capital assets. Are you able to understand? Category 2, immovable property. Immovable property means either land or building or both land and building. Next, second one is unlisted shares. Unlisted shares can be either equity shares or preference shares. So when you transfer immovable property or unlisted shares, they will fall under category 2. Under category 2, criteria is 24 months. If they are held for less than or equal to 24 months, short-term capital asset. If they are held for more than 24 months, long-term capital asset. Remaining capital assets, those capital assets which are not covered under category 1, category 2, remaining all capital assets will fall under category 3. For category 3, criteria is 36 months. If they are held for less than or equal to 36 months, short term capital asset. If they are held for more than 36 months, they are classified as long term capital asset. Are you able to understand? This is the criteria before 23rd July. Okay, don't get confused. Whenever you see capital gains problem, always first you need to check is date of transfer. If date of transfer is before 23rd July, tax rates are different. Criteria for classification, long term or short term, that criteria is also different. On or after 23rd July, another criteria will apply. So for your attempt, especially, this is amendment. I say will ask a question. It also asked in May 25. It will also ask in September 25. Whenever you read capital gains question, what is the first thing that you need to check? Date of transfer. If date of transfer is before 23rd July, separate tax rates, separate classification. If date of transfer is after 23rd July, separate tax rates, separate classification. Are you able to understand? Now, sir, date of transfer on or after 23rd July 2020, or after 23rd July 2024, then there are only two criteria: category 1, category 2. Listed shares or listed securities including units. This is the amendment. See, before 23rd July, listed units are excluded from category 1. But on or after 23rd July, listed units are also included in category 1. That is the major difference, major amendment. Before 23rd July, listed units are excluded from category 1. They will fall under category 3. But on or after 23rd July 2024, listed units are also falls under category 1. For listed units also, criteria is 12 months. Are you able to understand? So listed shares or securities including units, zero coupon bonds, units of UTI, units of equity oriented mutual fund. All these are considered, like for all these the criteria is 12 months. If they are held for less than 12 months, short term capital asset. If period of holding is more than or equal to 12 months, sorry, if period of holding is more than 12 months, long term capital asset. If period of holding is exactly equal to 12 months, then also short term capital asset. Is it clear? Remaining all capital assets. Okay, so you need to remember only four: listed shares, listed securities including units, zero coupon bonds, units of UTI, units of equity oriented mutual fund. For all these four capital assets, okay, criteria is 12 months on or after 23rd July. For remaining capital assets, immovable property, gold, jewelry, painting, sculpture, any other capital asset, there is only one criteria: 24 months. There are only two categories: category 1, category 2. So after 23rd July, either 12 months or 24 months, 36 months wala concept that is no more applicable. Are you able to understand? Next, see, you know depreciable capital assets, right? Depreciable capital assets, depreciable capital assets and capital assets under section 50AA. These two capital assets these two are always treated as short-term capital assets. That means on transfer of these capital assets, short-term capital gain or short-term capital will arise. Able to understand? Next, period of holding. You know period of holding, right? Period of holding will be calculated from date of purchase up to the date prior to the date of transfer. That means date of transfer is excluded from definition of period of. I will tell one small example. Date of purchase, date of transfer. Now, let's say I purchased on 10th June 2021. I sold on 5th May 2024. In this case, period of holding will be calculated from 10th June 2021 to 4th May 2024. Very, very important. Whatever the date of transfer is there, that should not be included in calculation of transfer. Are you able to understand? Date of transfer is to be excluded. Period of holding will be calculated from date of purchase up to the date prior to the date of transfer. Is it clear? Are you able to understand? Whatever the date of transfer is there, that is to be excluded. So there are 6 cases: conversion of preference shares into equity shares, conversion of debentures, bonds, debenture stock or deposit certificate. Next, conversion of gold into electronic gold or electronic gold into physical gold, exchange of amalgamating company shares to get amalgamated company shares, exchange of Vodafone shares to get VI shares. Okay, next, like allocation of shares, resulting company shares to shareholders of demerged company, transfer of shares of resulting Indian company in scheme of demerger to demerged company shareholders. In all these 6 cases, period of holding is equal to period of holding of current capital asset plus period of holding of previous capital asset. Are you able to understand? Let's say, like, initially I purchased preference. Later on, at the time of redemption, I did not take cash. I converted my preference shares into equity shares. Now, period of holding of equity shares is equal to period of holding of equity shares plus period of holding of preference shares. Are you able to understand? Shares acquired from primary market, bonus shares, sweat equity shares, right shares. For all these shares, period of holding is equal to for all these shares, period of holding is equal to date of allotment. See, when you purchase shares from primary market, you will make application, then company will allot. So there is no date of purchase. There are only two dates: date of application, date of allotment. On date of application, you do not know whether company will allot to you or not, but on date of allotment, it is certain you got shares from company. So in case of shares purchased in primary market or bonus shares or right shares, sweat equity shares, date of purchase is not available. That's why we will calculate period of holding from date of allotment of these shares. Are you able to understand? Rights renouncement. In case of right renouncement, period of holding will be calculated from date of offer of such shares by company up to the date of renouncement. What do you mean by this? You know right shares, right? Actually, I am shareholder of Infosys. Infosys wants to allot extra shares to me. I am thinking to sell existing shares. Why will I purchase new shares? I don't want to purchase new shares. So Sinduri is there. Sinduri came to me and asked, sir, anyhow you are not purchasing Infosys shares, so please renounce those shares to me. I will purchase those right shares at concessional rate. I accepted. Okay. So actually I have to pay 100 rupees to purchase right shares. I don't want to buy. So I renounced those shares to Sinduri for 5 rupees each. Now I am making profit by way of renouncement, right? 5 rupees. So in this case also capital gains are required to be calculated. Period of holding is equal to the date on which I got rights offer from the date up to the date of renouncement. That period will be considered as period of holding. Okay. Property acquired in any mode given under section 49(1). See, there are 49(1) means 5 cases. Like at the time of partition of HUF, capital assets will be transferred from Hindu undivided family to small family. Gift will or inheritance, like that is excluded from definition of transfer. Transfer of capital assets from holding company to subsidiary company or subsidiary company to holding company subject to two conditions. 100% subsidiary recipient company must be an Indian company. Next, conversion of capital asset into transfer of capital assets from amalgamating company to amalgamated company, transfer of capital assets from demerged company to resulting company. In all these cases, what is happening? Capital asset is transferred from one person to another person, but transfer of capital asset is not a transfer and no capital gains are required to be calculated. Correct? Now, let's say from Hindu undivided family to small family, capital asset is transferred. Is it a transfer? Not a transfer. Whether are you required to calculate capital gains? No capital gains are required to be calculated. Now, tomorrow, small family sold asset. Now they are required to calculate period of holding, right? So at that time, period of holding means period of holding of Hindu undivided family and period of holding of small family. Okay, period of holding of Hindu undivided family plus period of holding of small family. So in these five cases, okay, period of holding is equal to period of holding of current owner. Here, who is current owner? Small family plus period of holding of previous owner. Previous owner means Hindu undivided family. So in these five cases, whenever capital asset is transferred, while calculating period of holding, you also required to consider period of holding of the previous owner. Is it clear? Are you able to understand? Format for computation of capital gain. See, depreciable asset I will discuss separately. In case of depreciable asset, they are always treated as short-term capital asset. But in case of non-depreciable asset, there are two things: long-term capital asset, short-term capital asset. The only difference is in case of long-term capital asset, you will claim indexed cost of acquisition or indexed cost of improvement. In case of short-term capital asset, you will claim only cost of acquisition and cost of improvement. That is the only difference. In case of long-term capital asset, you will claim indexed cost of acquisition, indexed cost of improvement. This indexed cost of acquisition, cost of improvement, that is also available up to 23rd July 24. After 23rd July 24, there is no concept of indexation except in one situation. Okay, now you know the format, right? First, you will take full value of consideration. It is also called as sale consideration. From that, you will reduce transfer expenses. Thereby, you will arrive at net consideration. From net consideration, you will reduce cost of acquisition or cost of improvement. Thereby, you are going to arrive at capital gain. Am I correct? In this way, we are going to calculate capital gains. The first thing is full value of consideration. So initially I planned revision for 2 hours, but considering this, it might increase. We may have class till 12:30 or 12:40 like that. I think it is fine for you na. At a time revision will be completed for capital gain. And this video will be uploaded in YouTube also. If you want, you can prove that. Because I don't want to rush. There is no point if I rush and explain everything in 2 hours. You will not understand. Now, full value of consideration. Sir, what do you mean by full value of consideration? On transfer of capital asset, you will get consideration. Consideration can be either monetary or non-monetary. If consideration is monetary, no problem at all. Whatever the amount that you received in cash or whatever the amount that you received in bank, that will be treated as full value of consideration. However, you received consideration in non-monetary terms, like you sold building, in return you received shares. Now, how to calculate full value of consideration? So generally, if consideration is non-monetary, fair market value of non-monetary consideration received will be taken as full value of consideration. Is it clear? Are you able to understand? Second point, if consideration, whatever the non-monetary consideration that is not ascertainable, in that case, whatever the capital asset that you have transferred capital asset fair market value will be taken as full value of consideration. Is it clear? Transfer expense. What do you mean by transfer expenses? With regard to transfer of capital asset, if you incur any expenditure, that expenditure you will call as transfer expense. Okay, let's say I wanted to sell the building. For sale of building, I need to incur certain, I need to give commission to the dealer or agent. That is expenditure incurred with regard to transfer of capital asset. So wholly and exclusively for purpose of transfer, if you incur any expenditure, that expenditure will be called as transfer expenditure. Transfer expenditure you can reduce while calculating capital gains except securities transaction tax. See, whenever you buy and sell listed shares or securities, you are required to pay securities transaction tax. Whatever the securities transaction tax that you have paid, that is not, that is transfer expenditure only, but that is not allowed as deduction while calculating capital gain. Is it clear? Cost of acquisition. You know cost of acquisition, right? Generally, cost of acquisition is equal to purchase cost plus incidental okay. Incidental expenses means what? To purchase that capital asset. If you have paid stamp duty or if you have incurred any registration expense, all those will be added to the cost of the asset. So generally, cost of acquisition is equal to actual cost plus incidental expense. But there are uh, some certain cases where cost of acquisition is different. In case of bonus shares, if bonus shares are allotted before 1st April, see, to get bonus shares, will you pay anything to the company? You will not pay anything to the company. In fact, you are getting bonus shares at free of cost. That's why cost of acquisition of bonus shares is zero. But if bonus shares are allotted before 1st April 2001, then cost of acquisition is equal to fair market value as on 1st April 2001. Because if any capital asset is purchased before 1st April 2001, you can take the benefit of fair market value, right? So that is why if bonus shares are allotted before 1st April 2001, cost of acquisition is equal to fair market value as on 1st April 2001. Is it clear? Next, intangible assets. If intangible assets are self-generated, goodwill. See, like let's say I built one brand, Phoenix by Uma. Goodwill was generated. I sold this brand. Then whatever the amount that I received, on total amount I am required to pay capital gains because on sale of self-generated goodwill, the value of goodwill, cost of acquisition is always treated as zero. If goodwill is purchased, then cost of acquisition is equal to actual purchase cost. Is it clear? Sweat equity shares are specified securities. Cost of acquisition is equal to fair market value of shares considered in calculation of perquisite under salaries. Sir, what do you mean by this? Sweat equity shares are specified securities. Let's say I am working in Infosys. Infosys recognized my efforts. Infosys gave some shares to me in Infosys only. So I will get motivated. I will work even better for the company. So when company performs well, company will pay me more dividend. Okay. So keeping that in mind, I will work more. So what company will do? All companies to motivate employees, they will allocate sweat equity shares. So in case of allocation of sweat equity shares, cost of acquisition is equal to whatever the fair market value on the date of allocation is there for sweat equity shares on the date of exercising the option. Okay, that fair market value will be considered as cost of acquisition. If you remember salaries, see why Infosys give sweat equity shares to me either at free of cost or at concessional rate because I am working with Infosys. So if I get any benefit because of sweat equity shares, that benefit is taxable to me under the head salaries. We will calculate perquisite fair market value of sweat equity share minus amount paid by shareholder. Balance amount is perquisite, that is taxable under salaries. So for calculation of perquisite under salaries, whatever the fair market value that I have considered, that fair market will be considered, value will be considered as cost of acquisition of sweat equity shares. Is it clear? Right renouncement. See, in previous example, I renounced my right to Sinduri. Okay. Now, in case of right renouncement, like I am not incurring any cost. Company allotted me right shares. I don't want to buy. I renounced it to Sinduri for 5 rupees. Total 5 rupees is my profit only. I did not incur any cost. So in case of right renouncement, in the hands of transferor, cost of acquisition is, but in the hands of transferee, cost of acquisition is equal to amount paid to company plus amount paid to renouncer. Let's say Sinduri paid 5 rupees to me and Sinduri paid 100 rupees to company to purchase the right share. So in the hands of Sinduri, cost is equal to 105. Are you able to understand? So whenever right renouncement is done, cost in the hands of transferor is zero. cost in the hands of transferee is equal to amount paid to company plus amount paid to renouncer. Is it clear? We have discussed the conversions now. Conversion of preference shares to equity shares, conversion of debentures, bonds, debenture stock, deposit certificates into shares or debentures. So in case of all these conversions, cost of acquisition is equal to cost of previous capital. Is it clear? Conversion of stock in trade into capital asset. See, I purchased a watch. This watch, whether watch is a capital asset? No, watch is mobile asset. I'm using this watch for my personal purpose. This watch does not have any gold, so this watch is not a jewelry, drawing, painting, sculpture. So watch is a personal effect. But I started watch shop, so I converted personal effect into stock in trade. On conversion of personal effect into stock in trade, am I required to calculate capital gains? I'm not required to calculate capital gains. I will tell another example. I am dealer of ACs. Whenever I am dealer of air conditioners, what air conditioner is to me, air conditioner will be treated as stock in trade. Am I correct? But in my showroom, one AC got damaged. What I will do? Will I go and purchase another AC? I am the dealer of ACs now. So from my stock, I will take one AC. I will install that AC. Am I correct? So whenever I install that AC in my showroom, I am making it as capital asset. So on conversion of stock in trade into capital asset, so what is the cost of capital asset? Cost of capital asset is equal to fair market value on date of conversion. Clear? Are you able to understand? This is the concept. Next, assets acquired by any mode. We have discussed transfer of capital assets from holding to subsidiary or subsidiary to holding, transfer of capital assets from amalgamating to amalgamated, transfer of capital assets from demerged to resulting. Next, transfer of capital assets at the time of division of HUF, gift, will, or inheritance. In all these cases, cost of acquisition in the hands of new owner is equal to cost of acquisition in the hands of previous owner. From Vodafone to VI, one land was transferred. In the books of VI, cost of land is equal to cost of land in the books of Vodafone. Are you able to understand? Is it clear? Next, gift. If gift is not taxable, let's say I gifted 40,000 worth of gold to Charan. Value of gift is less than 50,000. It is not taxable to Charan. In that case, in the hands of Charan, cost of acquisition is equal to 40,000 rupees. Whatever cost in the hands of previous owner is there, same is the cost in the hands of new owner also. However, if gift is taxable, then cost of acquisition is equal to fair market value or stamp duty value that is considered in calculation of gift, considered in valuation of gift under other source. Is it clear? Shall I explain further? Capital gains is so vast, is such a chapter. How much you tell, still something will be there. PGBP is BAP of capital gains. Okay, that is also lengthy, but we have no other alternative other than studying. I have no other alternative other than teaching. Okay, at least in this way, revision is happening to you quickly. If you sit for revision, lot of deviations will come. Okay, someone will call or some deviation will be there, or you will not have a right mood. But in this way, we are having one-on-one communication, right? It's like you are not preparing on your own. You are listening to my class. You already listened to my regular class. This is like revision. So fatafat at one stretch, revision of capital gains will get complete. practice is there for you, na sir. I did not understand. Yeah, CA practice is there. Clients are calling me, but they are IT written clients. I can answer them in the afternoon. If any important client calls, I have no option. During live session also, I will halt. I will address him because that is giving me money. If I ignore it, it will affect my financials. Next, fair market value as on 1st April 2001. Shall I explain? See, before 1st April 2001, if you purchase any capital asset, you can take benefit of fair market value as on 1st April 2001. If you purchase movable asset before 1st April 2001, then cost of acquisition is equal to either fair market value as on 1st April 2001 or actual cost, whichever is higher. If you purchase capital asset, immovable property, if you purchase immovable property before 1st April 2001, then cost of acquisition will be calculated in three steps. Step 1, stamp duty value as on 1st April 2001 or fair market value as on 1st April 2001, whichever is lower. Step 2 is actual cost. Step 3, cost of acquisition is equal to step 1 or step 2, whichever is higher. What do you mean by this? Let's say I will quickly take one example. In 1995, I purchased one land. Actual cost is 10 lakhs. As on 2001, stamp duty value is 15 lakhs. Fair market value is 16 lakhs. Now, how much is my cost of acquisition? Step 1. Stamp 15 lakhs or 16 lakhs, whichever is lower. That means 15 lakhs. Step 2, actual cost 10 lakhs. Step 3, cost of acquisition is equal to step 1 or step 2, 15 lakhs or 10 lakhs, whichever is higher. That means 15 lakhs will be considered as cost of acquisition. Is it clear? Did you understand? So, if you purchase any tangible capital asset, very very important, you purchased patents before 1st April 2001, you will not get fair market value benefit as on 1st April 2001. Are you able to understand? So only for tangible capital asset, if date of purchase is before 1st April 2001, cost of acquisition is equal to actual cost or fair market value, whichever is higher. In case of immovable asset, three steps. Step 1, stamp duty value or fair market value, whichever is lower. Step 2, actual cost. Step 3, cost of acquisition is equal to step 1 or step 2, whichever is higher. Cost of improvement. You know improvement, right? Very very important. You purchased one capital asset. On that capital asset, you are paying revenue expenses. Revenue expenses are not cost of improvement. On capital asset purchase, if you incur any capital expenditure, that will be considered as cost of improvement. I purchased one ring. Ring is capital expenditure. Okay, ring is a capital asset. On this ring, for polishing, I paid polishing charges. I get my ring polished. It is revenue expenditure. In this ring, I have shown one diamond. Okay, whatever the diamond is there, it enhances my ring value. So diamond is capital expenditure. So it will be treated. Whatever the expenditure of diamond is there, that will be considered as cost of improvement. Are you able to understand? So on any capital asset, if you incur capital expenditure after purchase of capital asset, that capital expenditure we call as cost of improvement. Is it clear? Are you able to understand? So like there are three conditions. Cost of improvement is available for tangible as well as for intangible assets. But cost of improvement should be incurred on or after 1st April 2001. The reason is, if you incur cost of improvement before 1st April 2001, it is already included in fair market value as on 1st April 2001. Na? That is the reason, if cost of improvement is incurred before 1st April 2001, it will be ignored. It will not be considered. Is it clear? So cost of improvement is allowed as deduction subject to satisfaction of three conditions. You can incur cost of improvement either on tangible assets or intangible assets, but you should incur cost of improvement on or after 1st April 2001, and cost of improvement should be incurred either by SSC or previous owner. Are you able to understand? If these three conditions are satisfied, then cost of improvement will be allowed as deduction. That means what? Either I can incur cost of improvement if I gift it to my brother. Whatever the cost of improvement incurred by me allowed as deduction, incurred my brother also allowed as deduction. But in case of goodwill, right to manufacture, right to carry on business, in these three cases, cost of improvement will be taken as. Are you able to understand? Indexation. This is also very important because in indexation also there is one which is there in Finance Act 20. Shall I explain indexation, everybody? Indexation. Indexation means what? In case of long-term capital asset, apart from cost of acquisition, higher cost of acquisition is allowed as deduction. That higher cost of acquisition we call as indexed cost of acquisition. Indexation means what? Higher cost of acquisition or higher cost of input. Let's say in 2007-8, I purchased one asset. Cost of that asset is 11 lakhs. In 2024-25, I am selling that asset. In 24-25 also, will the cost be same? Can I purchase it only at 11 lakhs? Not possible, na? So that's why indexed cost of acquisition will be allowed as deduction. For calculation of indexation, we will take index numbers. Let's say index numbers are given here. For 11-12, index number 184. For 24-25, index number 363. So 7-8 na. Index number for 7-8 is 129. So 7-8, index number 129, 24-25, index number 363. In 7-8, cost is 11 lakhs. In 24-25, how much is the cost? Do cross calculate. How much? 11 lakhs divided by 129 into 360. 30 lakh 95,340 will be considered as indexed cost of. That means in case of long-term capital asset, not cost of acquisition, indexed cost of acquisition, higher cost of acquisition allowed as here. So here what is the formula? 11 lakhs into 129 by 363. We can convert this into formula. Indexed cost of acquisition is equal to cost of acquisition to cost inflation index in the year of transfer divided by cost inflation index in the year of purchase. See, sometimes you can purchase asset before 1st April 2001. If you purchase asset before 1st April 2001, then you will consider index number of 2001. So cost inflation index in the year of purchase or cost inflation index of 2001 to whichever is later. Able to understand? Is it clear? Why, sir? Already we are taking fair market value benefit as on 1st April 2001. So we have fair market value. On that fair market value, we will apply indexation from 1st April 2001 on. That's why Indexed cost of acquisition is equal to cost of acquisition into cost inflation index in the year of transfer divided by cost inflation index in the year of purchase, or cost inflation index for 2001 to whichever is later. Same is the case with indexed cost of improvement. Indexed cost of improvement is equal to cost of improvement into cost inflation index in the year of transfer divided by cost inflation index in the year of improvement. Sir, or 2001 too, don't take that. I already told you, for cost of improvement, if any improvement is made before 2001, it needs to be ignored. So there is no concept of a cost inflation index for 2001. Okay, so cost of improvement is allowed as deduction only if it is incurred after 1st April 2001. That is why while calculating indexed cost of improvement, formula is cost of improvement into cost inflation index in the year of transfer divided by cost inflation index in the year of. Is it clear? Now, see, in case of bonds or debentures, indexation benefit is not available. You cannot, even though bonds and debentures are long-term capital asset, you cannot claim indexation benefit. Next, capital indexed bonds by government. So generally, on bonds, indexation benefit is not available even though they are long-term capital asset. But in case if bonds are issued by government, then on those bonds indexation benefit is available. Next, sovereign gold bonds issued by RBI or sovereign gold bonds issued under gold bond scheme. In case of sovereign gold bonds, you can claim indexation benefit only if they are long-term capital asset. Depreciable capital assets, section 50C, we already discussed. In case of depreciable capital assets, they are always treated as short-term capital asset. As they are always treated as short-term capital asset, indexation benefit is not available. Are you able to understand? Unit of specified mutual fund acquired on or after 1st April 2023, market linked debentures. These are new amendment 50AA. So if any capital asset is covered under 50AA, always treated as short term capital asset. So market linked debenture, unit of specified mutual fund acquired on or after 1st April 23, for these two capital assets, as they are always short term, you cannot claim indexation benefit. Next, section 112A. Those capital assets which are covered under section 112A, under section 112A indexation benefit is not available. Next, virtual digital asset, cryptocurrencies. You bought Bitcoin, you sold Bitcoin, you bought Bitcoin 5 years ago, now you are selling it. Can you claim indexed cost of acquisition? No. In case of virtual digital asset, indexation benefit is not available. With regard to other long-term capital assets, indexation benefit is available, that too before 23rd July 2024. Okay, so on or after 23rd July 2024, there is no concept of indexation except in one situation. Are you able to understand? So generally before 23rd July 24, indexation benefit is available, but on or after 23rd July 24, indexation benefit is not available except only in one situation. What is that situation? I will explain at the end when I am explaining tax rates. Are you able to understand? So till here, are you clear? Everybody, lot of stuff we are discussing today. So shall I continue or do you need any small break? Continue. Okay, fine. Next we will discuss exceptions to method of accounting. Generally method of accounting under the head capital gains is accrual basis. But there are three cases. In these three cases, we do not calculate capital gains on accrual basis. but we will calculate capital gains on cash basis. First example, damage or destruction of capital asset. See, building got collapsed. You got insurance compensation. Whatever the insurance compensation that you have received, that will be taken as full value of consideration. So whenever there is damage of capital asset, in that case, year of transfer is not year of destruction. Year of transfer is year in which you are receiving the compensation. So in case of damage or destruction of capital asset, capital gains are taxable not in the year of transfer, not in the year of damage or destruction, but capital gains are taxable in the year in which the compensation is received from insurance company. Are you able to understand? Next, whatever the insurance compensation received, that will be taken as full value of consideration. Period of holding, generally period of holding will be calculated from date of purchase up to the date prior to the date of transfer. So even in this case also, period of holding will be calculated from date of purchase up to the date prior to the date of damage or destruction. Is it clear? Indexation benefit. Indexation benefit is available, but indexation benefit is available from date of purchase up to the date prior to the date of damage or destruction. Is it clear? That means what? Indexation benefit, period of holding, you should not calculate till the date of receipt of compensation. You have to calculate only up to the date of damage or destruction. Is it clear? Now you will get one doubt. Sir, if we get insurance compensation in cash, whatever the cash compensation that we have received, that will be taken as full value of consideration. But if you receive a compensation in non-monetary terms, let's say I received insurance compensation in the form of immovable property. My building got collapsed. Insurance company constructed new building. Insurance company gave me new building. Now I am getting consideration in the form of immovable property. Then whatever the fair market value of immovable property received is there, that will be taken as full value of consideration. Able to understand? Fair market value. Charan, you are correct. Okay. Next, you will get one doubt. Sir, stock in trade got destroyed. If stock in trade gets destroyed, PGBP head gets attracted, it will not be covered by provisions of section 45 1A. Capital gains head will not get attracted. Are you able to understand? See, here there is one interesting thing. What is the interesting thing? My building got collapsed. I did not get insurance compensation. Can I claim cost as deduction? Can I show it as capital loss? I cannot show. When building is collapsed, and if I get insurance compensation, then only capital gains are required to be calculated. That means what department is saying, whenever there is destruction of capital asset, if you get income, then calculate capital gains. If you do not get income, don't calculate capital gains. That means in case of section 45 1A, if you want to calculate capital gains, first there should be destruction of capital asset. Second condition, you should receive compensation. Conjunction is and. Both the conditions are required to be satisfied, then only capital gains will be calculated. Otherwise capital gains will not be calculated. That means there should be destruction and insurance compensation also should be received. If you do not get insurance compensation, 45 1A will not get attracted. Whatever your loss of destruction is there, that loss is a dead loss. That loss you cannot set off in income tax calculation. Is it clear? Only when you get insurance compensation, then you will calculate capital gains. Is it clear? Section 45(2), conversion of capital asset into stock in trade. I told morning one example na, 50 kgs of gold in my home that I converted in, like that I brought into business. Please don't think 50 kgs is there. If 50 kgs is there, I will not take this much of struggle explaining all these things. Okay, I will get so much of income. Okay. There is conversion of capital asset into stock in trade. See, and tomorrow I will sell stock in trade. On conversion of capital asset into stock in trade, is it treated as transfer? It is not a transfer. Capital gains are not required to be calculated. But sale of stock in trade, the year in which I sold the stock in trade, in that year I am required to calculate capital. So, upon conversion of capital asset into stock in trade, capital gain is not taxable in the year of transfer. Capital gain is not taxable in the year of conversion, but capital gain is taxable in the year in which stock in trade is sold, in the year in which you are selling the stock in trade. That is the exception. That is the exception to method of. On conversion of capital asset into stock in trade, whatever the fair market value is there, that fair market value will be taken as full value of. Next, period of holding. In this case, you do not calculate period of holding till the date of sale. That is not correct. You will calculate period of holding from date of purchase of capital asset up to date of conversion. Are you able to understand? So period of holding will be calculated from date of purchase up to date prior to the date of conversion. Are you able to understand? Up to date prior to date of. Next, indexation benefit also same. Indexation benefit will be calculated from year of purchase up to the year of conversion. Is it clear? So that is the concept relating to conversion of capital asset into stock in trade. But one exception is there. I converted my personal effect into stock in trade. Will it be trapped by provisions of 45(2)? No, it will not be trapped by provisions of 45(2). That means if I convert my personal effect into stock in trade, 45(2) will not get attracted. 45(2) gets attracted only if I convert my capital asset into stock in trade. Then only 45(2) gets attracted. Otherwise, 45(2) will not get attracted. Is it clear? Now, in the year in which stock in trade is sold, in that year, you will calculate capital gains. You will also calculate PGBP income. Two incomes you will calculate because in the year in which stock in trade is sold, money is available with SSE. So, on that money, capital gains will be calculated, PGBP income will also be calculated. For this period, like capital gains will be calculated. After conversion for this period, PGBP income will be calculated. Whatever the fair market value on the date of conversion is there, this will be taken as purchase cost in calculation of PGBP income. Okay. If personal effect got converted into stock in trade, it is not at all taxable. It is not taxable under other sources also. It is loop. Okay. When you convert personal effect into stock in trade, it is not at all taxable. Not taxable under other sources also. Okay. Next, section 45(5). Compulsory acquisition of capital asset. Now, section 45(5). Whenever capital asset is compulsorily acquired by government will pay compensation. So, whenever compulsory acquisition is done, that is also considered as transfer and capital gains are required to be calculated. Are you able to understand? Now, one thing, whenever compulsory acquisition was done, in that year already SSE is crying. Now, if income tax department comes and asks him to pay tax, SSC will start beating department. Correct? So that's why whenever there is compulsory acquisition, capital gains are required to be calculated, but they will not be calculated in the year of compulsory acquisition. They will be calculated in the year in which compensation is paid by government. Are you able to understand? So whenever compulsory acquisition is done, year of transfer is year of compulsory acquisition. But in year of compulsory acquisition, capital gains are not taxable. They are taxable in the year in which compensation is received from government. Sir, what is to be taken as full value of consideration? Whatever the compensation received from government is there, that will be taken as full value of consideration. Is it clear? Are you able to understand? Compensation received from government will be taken as full value of. Period of holding will be calculated from date of purchase up to the date prior to the date of compulsory acquisition. Even in case of compulsory acquisition also, indexation benefit is available. Indexation benefit is available from year of purchase up to the year of compulsory acquisition. Is it clear? Sir, if compensation is received in installments, even though compensation is received in installments, entire compensation is taxable in the year in which first installment is received. Are you able to understand? So there is like you are getting compensation from government in parts, some amount in this year, some amount in next year, like that. Even though you receive in parts, even though you receive in installments, entire compensation is taxable in the year in which first installment is. Now, whatever the compensation that is received, SSC is not happy with that compensation. Now, what SSC can do? SSC can file case in court or appellate authority for enhanced compensation. Whenever SSC files case in court, if court is satisfied, then court will grant enhanced compensation. Enhanced compensation is also taxable under the head capital gains. See, already while calculating original capital gains, you will claim cost of acquisition, you will claim cost of improvement. So whenever you get enhanced compensation, from enhanced compensation, you cannot claim cost of acquisition and cost of improvement. Enhanced compensation is fully taxable, but only deduction allowed from enhanced compensation is legal expenses. Are you able to understand? Sir, whether enhanced compensation, whether it is long-term capital gain or short-term capital gain, when you calculate original capital gains, whatever the nature is there, original capital gains are long-term. So enhanced compensation is also long-term. Original capital gains are short term. So enhanced compensation is also short term. Are you able to understand? Along with enhanced compensation, you received interest on enhanced compensation. Interest on enhanced compensation is taxable under the head income from other sources. But interest on enhanced compensation is not fully taxable. 50% deduction is allowed and only balance 50% is taxable under the head income from other sources. Is it clear? So that is the concept. Now, revision. For example, let's say I got 80 lakhs compensation. I'm not happy with 80 lakhs. I filed a case for getting extra 30 lakhs enhanced compensation. Court gave judgment 80 lakhs compensation is very high. Give only 50 lakh rupees compensation. Now court reduced the compensation. Now, whenever compensation is reduced by court, you need to recompute the capital gains. And after recomputing capital gains, whatever the extra capital gain tax that you have paid in earlier years is there, that you can claim as refund from income tax department. Are you able to understand? So students, uh, let's do one thing. Already 1 hour 45 minutes is over. I'm feeling hungry because I'm talking continuously. So shall we take some uh, half an hour 45 minutes break? And shall we connect at the rate 12:30 like that? Or 1 o'clock? Shall we connect at 1 o'clock? 1 to 2 we will discuss further. Remaining section 50 series. See, three topics are pending. Four topics. Section 50 series, exemptions, 112A, 111A, tax rates. I need to explain these four topics. Once I revise these four topics, revision of capital gains is over. So shall we take some break? Because these four topics will take another 1 hour. Okay, so one, is it possible, Charan? All people who are there, please reply. 1 o'clock, okay? Meanwhile, you also have lunch. 1 o'clock, 1 to 2, or if it is tough for you, you may also have lunch at 1 o'clock. Let's meet at 1:30, okay? 1:30 to 2:30, or maximum 3. Second revision, balance revision, 1:30 to 2:30, or maximum 3. We will finish the revision. Okay, let's meet at 1:30. I will send you, like, I will come live. You will get the notification if you subscribe my channel. Please join. We can clear balance revision at 1:30. And one more request, if you want any problems to be taught by me in 1:30 revision, please, whatever the problems that you wanted, please upload in our Telegram group. I will explain those problems also. Not at all. Okay. Thank you. Bye. Bye for now. We will again meet at 1:30.